Hi everyone, it's Grant Abbott speaking, and thank you all for attending. I'm sure you can all hear me pretty well. If you just put your hands up or go into the chat, let me know that you can hear me properly. You can see we've got our video all ready to go over in Sydney. So this is a multi-dimensional, I should say multi-dimensional, but it's certainly covering all the bases. We were going to go to we've already done these sessions in Sydney and also Melbourne, and they've been very well received. I'm going to keep it hard-hitting and pretty fast for you today. The key issues we want to look at is obviously the Commissioner's new investment strategy guidelines. I just did an auditors session the other day for the SMSF Auditors Association, where there were more than 300 people on. And I can tell you there's a lot of shock and awe when it comes around to the SMSF auditors. As if we're not all shock and awe anyway with coronavirus. We were supposed to be doing this session in Brisbane the other day. We've had to make this a virtual session, and also Adelaide and Perth. So we're not travelling there next week. So this is a once-off session, but it will be recorded and will be up and running. In fact, we have got the full video of this session from Sydney the other day. Now, you've got your chat there and Q&A, so please feel free to ask questions along the way. A couple of things that's important: if you are on this session, you can claim CPD. So how are you going to do that? You'll find that if you go to the I Love SMSF website, so that's pretty easy, you can see that up on the screen, the I Love SMSF website, so ilovesmsf.com, and you'll see up the top there, that we've got a bar that says CPD submission. So if you just click on that, and again, if you just put in there, we've got Adelaide, Brisbane or Perth, whichever one you're supposed to go to, please feel free to make sure that you put that down. As an aside, for those of you, make sure that you do get your points up between now and 30 June, because ASIC is going to name and shame. We've all got our technical points up quite easily. It's all those other ephemeral ones, such as 9 hours of professionalism and ethics, 5 hours of client care, and 5 hours of corporate regulatory issues. I've already done a session on that the other day, which had 1 hour, and you'll see through if you just keep in touch with us, make sure you're on our I Love SMSF, you've registered on our website, or like your docs on the website. We're going to be continually rolling out a lot of CPD in those other esoteric areas. So this one is 50% client care and also 50% technical. So I'll be going through that. We're going to be looking at Australian Solar. The guys, you can see Chris up on the screen there getting things ready. The guys from Australian Solar are going to come in. They've got an awesome product which is really pitched for the times at the moment, with interest rates virtually at nothing. I think the best interest rate you can get now on a term deposit is just over 1%. They've got I got involved with them a couple of years ago, and they've got a really good Australian solar farms they're building in regional areas, particularly over in Perth. There's their second one over there. And those power plants you can effectively invest in as an investor, and they've got redeemable prefs paying 7%, which is well and truly above anything else in the market. And the good thing about it is the 7% is paid directly out of the contracts they've already pre-sold for electricity. But I won't take that. I'll look at wine. So make sure you get your CPD submission. What we're going to look at, from my perspective, is that investment strategies right from the very start. When I built my first investment module under the SMSF strategies, or actually strategist group, we essentially had a look at investments, and a lot of the Commissioner's guidelines for auditors at that time, and these were very nascent days way back in 2001. The Commissioner only really taken over in July 1999. And in those days, he said basically, look, 0 to 100% was the asset allocation. If you had an asset allocation of 0 to 100%, then effectively what you've got there is it's not exactly an investment strategy. But lo and behold, that sort of went in and out for, well, now we're 20 years on. It's never been enforced. And then last year in September, many of you are probably pretty well aware that the Commissioner came out and essentially said that from his perspective, that really he focused in on LRBAs, leverage investments, and we're going to look at his ruling very shortly and get into that, that effectively where there was leverage, he was concerned about concentration risk. It was a pretty, it was a bit of a wishy-washy letter, but the main thing is the letter went out to clients, not administrators or accountants, and also went out to auditors. He's now taken it even further, as we'll see, and I'm going to take you through exactly where to go, but that now he's made a proclamation, which effectively is both retrospective and prospective is both retrospective and prospective in terms of the application of the guidelines. So I want to look at that. I bounced out a little bit earlier there. So a couple of things as we go through. What I want to do is look at what are SMSF auditors going to do, and I've got a pretty good insight on that, having a chat with a lot of auditors over the last 2 or 3 months. Is he going to go back to past years? I'd say we really need to make sure that our act is cleaned up for 2019 as well as 2020. What's he going to do about 2019? Many of you are right in the midst of doing your audit or compliance for 2019. As was discussed, and I had a chat with a couple of auditors live the other day of the session, you can't be doing your 2019 investment strategy now. It's non-compliant. You have to do an investment strategy at the start of the year, or at least during the year at some point in time. So if you're doing an investment strategy now, you're covering 2020. If you want to use the investment strategy you're doing now, you really need to do what we call a deed of rectification and deed of ratification. It's something that Abbott-Family lawyers, we do all the time. In fact, I was up at 5 o'clock this morning doing a couple in relation to LRBAs going way back, rectifying deeds way back to 1970, if you can believe. It wasn't even self-managed super, just very old employer fund. So I want to show you how to do that. We'll need to go and see what the commissioner says, and then I need to bounce out of there and actually show you how to fix these up. So the easiest way to do it is, and you can see I've got a lot of rubbish up there, but the easiest way to look at it is if you just go ATO, you can see there, just do a search on Google, as all your clients can do. So ATO investment strategy for self-managed superannuation funds. I put that in, you can see there the relevant date there is February. See that? February the 17th, 2020. So this is his guideline for trustees of self-managed super funds. Now I'm just going to open that up so you can see it a little bit better. And we'll go through it. So we've got the general blah, 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 your investment strategy of your plan for making, holding, and realising assets consistent with your investment objectives. So again, it's a plan. So it's a plan, which means a plan, anyone, is if I said to you, now what I want you to do is now plan for everything that you did in Christmas 2019. So let me say that again. I want you to sit down here now and make a plan for everything you did at Christmas in 2019. And you sort of get the drift is that an investment strategy is forward-looking, having regard to the objectives of the fund, and therefore it's a forward-looking document. You can't go back. I can't plan 2019 because of my timeline, it's already done. So it's got a nice little video there. See this one where it says super laws? There is a new sheriff in town. That's a sheriff's badge. But John O'Halloran is the new Assistant Commissioner of Taxation for superannuation, which is why we're getting a lot more focus, they're getting a lot more aggressive now on self-managed superannuation funds. So let's start to go through and pick it apart. So your SMSF investment strategy should be in writing. Now, I've had hundreds of arguments over the years going right back to 2001 and before that, when it was even right back in 96 or 97, when the Insurance and Superannuation Commissioner, which was then followed by APRA, took over SMSFs prior to 1999 when the tax office took over. Essentially, if I took us to the legislation basically says that an investment strategy must be taken into account. Now, it becomes part of the governing rules of the fund, but it doesn't say it have to be in writing. So a lot of people are saying, well, verbal's okay. However, how can you have a verbal investment strategy that an auditor will sign off on? So it doesn't make sense. So quite clearly, it needs to be in writing. Here's important: it should also be tailored. to this and specific to the relevant circumstances of your fund, rather than a document which repeats the words of the legislation. In fact, it was funny, on the auditor's session the other day, one of the auditors said that, I can't believe this, I'm shaking my head here, unfortunately you can't see me, in fact I'm almost hitting my head on the ground. They said that they had 10 different templates. They had 500 client funds, 10 different templates that they were using for their SMSFs, and they would choose which one was appropriate. Now, the problem about that is, you can see here, everything has to be tailored to your fund, which means one template, 10 templates, 100,000 templates is not going to do. We need to be something that's tailored. Now, importantly here, and this is a big change, relevant circumstances may include, but are not limited to, personal circumstances of the members, such as their age, employment status, retirement needs, which influence your risk appetite. Now, notice how there's a bifurcation there. Does everyone understand that one? So let me just go through. Relevant circumstance may include personal circumstance of the members, such as their age, employment status, retirement, which influence your risk appetite. So the member's risk appetite is immaterial. It's the trustee of the fund. We've got a bifurcation here, that we've got a trustee and then we've got a member of a superannuation fund. Now, when drafting up that investment strategy, it must, absolutely must have the member's details embedded in it. For that perspective, I would say, having a look at that, it needs to put in the members' names, it needs to put in the members' ages, whether they've got insurances, obviously, and also include what stage are they in the fund. Are they 65 in a pension? Are they 75 in a pension? Or are they 41 and in the accumulation phase? So we're going to have a look at that a little bit later on. And your strategy, remember, is talking here to the trustee of the fund. Your strategy should explain how your investments meet each member's retirement objectives. So that if we've got pensions in there, how does our investment strategy meet that? Do we have enough cash to pay pensions? And you can start to see, once we get all of these things together, there can be 1 billion, even 100 billion different methodologies of doing an investment strategy. You'll see a little bit later on, towards the end of the session, I'm going to show you the Lightyear Docs investment strategy that has 100 billion different options. And what is that it can be tailored for each and every one of your clients. Importantly, from that perspective, I've had a couple of people say, can you give me a template? And again, we're going back to this template stuff. You can't do a template. In fact, it's impossible for me to give. I could give you one template out of 100 billion that's never going to fit your client's circumstances. I'm going to take you through, I'm going to show you why. Anyway, in particular, under the super laws, you've got to have a look at the risks involved. And I think we all know this. This is stock standard stuff, including, all of this is out of 52B to F. But if we have a look at Regulation 4.09, which the Commission likes to talk about, that's where insurance cover is covered as well. So you've got to look at life, permanent, TPD for each member of the fund and whether to hold. Now, this is the first foray into the 0 to 100%. Now, many of us in the past, and it may have been only a short time ago, it could have been some people who signed off 2019, lodged their returns already with 0 to 100%. That is a disaster. Not so much for the members, they don't care, but certainly a disaster for the auditor and particularly the administrator. And I also want to talk a little bit later on where you fit in, if you're an accountant administrator, how you can solve this, that one, you don't need to be licensed in order to do that. And again, remember the bifurcation, the investment strategy is for who? It's for the trustee of the superannuation fund. It is not and never will be for the members of the fund. And the risk strategy or the risk involved has to be, if we're looking at investment risk, has to be looked at in terms of the trustee, not the member's risk aversion or the member's risk allocation. Now, when formulating, again, this is straight off the ATO website, this is for trustees of funds. When formulating your investment strategy is not a valid approach to merely specify investment ranges of 0 to 100% to each class of investment. You also need to articulate how you plan to invest your super, or why you require broad ranges to achieve your investment goals or satisfy investment strategy requirements. Now, this is a better way. The percentage or dollar allocation, you can't do dollar. The problem about it, if I did a straight dollar allocation, I'm always going to blow up. Now, I could actually say, if I went in and said my dollar allocation is between, for cash, is between 50,000 to 90,000, then that'd be okay. But if I came in and said my dollar allocation is now, it's it's $500,000, $772, that's not going to apply, because immediately I'm going to breach that. It'll never ever be, it'll be that amount, but I'm going to be changing things around it. So no one really does dollar allocation. So if we have a look at the percentage of the fund's asset invested, each class of investment should support and reflect your articulated investment approach to achieving your goals. So let's go down a little bit further. This is a big one, and I'm going to highlight that. See that one? Are there any restrictions under the super laws with respect to my SMSF investments? We had a number of instances when it came out with those guidelines from the Commissioner, where he basically was saying, look, people were saying, look, the Commissioner can't tell me what to invest in. And importantly, he's not telling you that. In fact, he says, you are free to choose what type of assets you may invest in, providing these investments are permitted by your fund's trustee, are not prohibited by the super laws, and meet the sole purpose test. So the Commissioner's putting hands up. As long as you don't breach anything, you can invest in basically whatever you want. For instance, you need to be aware of the in-house asset rules and acquisitions from related party rules. You also need to be aware of the non-arm's length income rules. And we're going to go through the breaches. So what does having regard to diversification mean, and can I invest all my retirement savings in one asset or asset class? Now, for many of you, you may have clients who are in their more advanced years who are effectively all in cash at the moment, particularly over the last 2 or 3 weeks, or you would have maybe gone defensive over a period of time. So if we had 100% investment in, for example, if we had in cash, the best cash rates we're getting at the moment, if we go to a bank, is probably going to be just over 1%. Now, that has a risk involved in it, because if I am 70, my PVF factor, unless the government makes a change, is going to be up around about 5%. If I'm earning 1%, it means there's a depletion of capital. If I'm up around about 90, where there's a 7% requirement, then it's going to be even worse. So I need to use that. So let me go through. Graham, that's a good question. So, hi Graham, using the 0 to 100% allocation, the ATO framing that. Question is, what happens if the client's trustee is not investing at all in a particular sector? There's nothing wrong with that. Again, we go back to this, is if we go up here, the Commissioner doesn't mind you investing all in cash, or all in equities, or all in property. But let's go through and see what he says. While a trustee can choose to invest all their retirement savings in one asset or asset class, certain risks such as return volatility and liquidity risk can be minimised if a trustee chooses to invest in a variety of assets. So, for example, excuse me. Oh, sorry, I hope that didn't blow your mind. Sorry about that, guy. This is called diversified portfolio, which helps to spread investment risk. You'll see a bit later on when Warren comes up and talks about the solar offering, which is a 7% yield. They have a number of different solar plants across Australia, in New South Wales, Victoria, and also Perth, again, to get that diversification risk. Likewise, you could have property being residential and industrial and commercial. If you have a look at what's happening in the market at the moment, commercial would be a little bit of a worry at this present point in time. But that gives you diversification within that asset class. Alternatively, you could have a balanced portfolio, such as a lot of industry funds do, which are in cash, fixed interest, property, and also equities. I had a look at the average balance of the non-SMSFs, and 52% of investments held by most industry and retail funds are held in equities. Of that, 50%, or around about 23% of the total portfolio, is in international equities. A lot of them have dropped down by, this is a balanced fund, 15 to 18% in the last week. And of course, we haven't seen any advertising by the industry funds actually discussing that over the last few weeks. Now, let's go a little bit further forward. Investing the predominant share of your retirement savings in one asset or asset class can lead to concentration risk. Now, this is the answer, Graham. In this situation, your investment strategy should document you considered the risks with a lack of diversification. It should also include how you still think the investment will meet your fund's investment objectives, including your fund's return objectives and cash flow requirements. So, for example, if I'm over in senior years over 65, so my PVF factor on my pension is 5% or above, then if I was invested in a product that had a good return, again, I'll just go back to Sol with 7%, then even if I did 100%, which you generally wouldn't do, at least you've got some parameters around how you've met your investment objective, your cash flow, so on and so forth. Now, here's this big thing, obviously. Asset concentration risk is highly heightened in highly leveraged funds, just as where the trustee uses limited recourse borrowing arrangement to acquire the asset. This can expose members to a loss in the value of retirement savings should the asset decline in value. It could also trigger a forced asset sale if low covenants are essentially breached, which we'll essentially have a look at. So the other one, let's go in, what does giving effect to my investment strategy mean? So the law says you have to give effect to investment strategy. It has to be in writing, diversification, cash, risks, etc. Now, the super laws require that as trustee, you must formally give review to your fund's investment strategy regularly. You must also give effect to investment strategy as regard the whole of fund circumstances. Now, I'll just jump through the next one. It's not a big one, but however, going back to what you're talking about, Graham, broad investment ranges between 0 to 100% in a broad range of assets do not reflect proper consideration in satisfying the investment strategy requirements. Now, what I want to do is I just want to bounce out of there, just go back, and I'm going to have a look at our presentation here. And I'm going to have a look at this one, if you can see. Now, the problem about it is that if the 52B2F basically says that your investment strategy forms part of the governing rules of the fund. Now, if you don't do an investment strategy, then quite clearly you've breached the investment strategy rules, if that makes sense. Now, if you did an investment strategy that simply set across all asset classes 0 to 100%, again, the Commission is saying there's no property consideration, therefore ipso facto, that document is not an investment strategy. If you did a document that went down the track, it didn't include members' details, ages, or looking at the specifics of the members, then quite clearly under these Commission's guidelines, that is not an investment strategy. And so what we need to do is be really clear about what is an investment strategy as per the Commissioner's published guidelines to trustees and what is not. Because when it moves into what is not an investment strategy and is simply a historical document or a document, then what happens is Section 54C of the SIS Act essentially says that there is a breach if there's a breach of the governing rules, ipso facto, the investment strategy, if there's a breach of that, then you've breached Section 54C. So if there's no investment strategy, or the document that you're looking at is not an investment strategy, then there's a breach of Section 54C. And the danger about that, and you're going to, one is you are going to like it or not like it, is Section 55(3) of the SIS Act says that the trustee of the fund and the members can sue any person, including an auditor, an administrator, a planner, or an accountant, who's been involved in that breach. So if you've put your hand up and you've actually built that investment strategy for the client, then effectively, if it is not an investment strategy, it's 54C breach, then 55(3) comes into play. And so I've had a look at here, which is absolutely, when I first did these slides, whoever thought that the fall in price by Westpac would actually be greater? Now, if I didn't have an investment strategy, which is 0 to 100%, and then the shares I've got investments being Westpac, and the client has sold them and realised a $50,000 loss, then potentially the auditor, and this was the same the other day, if the auditor's already signed off that the 0 to 100% is an investment strategy, The client can then go back against the auditor under 54C and 55(3) and recover that $50,000 loss. So, Graham, I'm going to be coming back and showing you exactly what to do in terms of not only global shares, but global fixed interest, global property. We need to make a determination that we cover all these asset classes and then look at them and whether we want to or not. So, Rex Walker, the SMSF might be one of several aspects to a member's investment portfolio, e.g. blah, 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 blah. The ATO guidelines don't specifically deal with the situation, but this could be a reason why a fund carries a concentration of assets, as I see, that will comply provided the risks, etc., were documented. Rex, we've got to be, that's a really good issue. We've got to be very, very careful on that one, because remember, we are building, the commissioner told us, the law tells us that we are to build the investment strategy for the benefit of, for the trustee. So the trustee has to look at all the members, retirement needs, etc. It doesn't specifically say that we need to look at other assets that the members may have, because the issue here is we're looking at an objective is to maximise the members' retirement income. So that at the end of the day, if a client has got property outside and then we decide to invest in shares inside our superannuation fund and they're 40 years of age, then we've got to say that those shares are to maximise the retirement portfolio of all the members when they are retired, obviously. We never say it's to do that plus the member has a lot of property outside. So it has to be localised to the trustee of the fund. Otherwise, we may find that it's a breach of the investment strategy, hence a breach of 55C and 55(3). And I want to come back and look at it a little bit later on as to what is included and what is excluded and where you guys fit in, particularly you accountants. Now, importantly, there is your strategy must articulate how you plan to invest your super. You said that many times. Now, this is a good one. So, like currently in the marketplace is important. So, a lot of our clients have got a benchmark allocation, and you want to be a bit flexible. So, you've got a benchmark allocation for equities of say between 40 to 70%. It may have dropped down below that, but you're still going to be invested in equities. Now, that means there's been a breach of the investment strategy, but this is a good one from my perspective. We don't consider that short-term variations to your articulated investment approach, say as equities, including the specified asset allocations, constitute a variation from the investment strategy. So that's a good one from the commissioner. So if we bounce out, and even if, for example, at the end of the day, okay, so Sherry, I'm going to have a look at the ACR or the reportables very shortly. That's a really good question. Now, how often do I need to review my SMSF investment strategy? Your investment strategy must not be a set and forget document. So if you've got one that's just piling on for the last 4 or 5 years, then you're out of bounds. So you should review your strategy depending your strategy regularly, ensure it continues to meet the current and future needs of your members, depending on their personal circumstances. So Rex, that absolutely may come in, but you have to have that as a blinkers on approach. We're looking at it in terms of our retirement needs for our members. The fact they're heavily invested in property obviously will take us into account, but when we write the investment strategy, it's for members only. Now, certain significant events should also prompt you to review your strategy, such as a bing bong bing, a market correction. So we need to go back anyway for 2020 and make sure that our 2020 investment strategy, which we're doing now, meets that particular element. When a new member joins the fund or departs the fund, and that may be from death. Now, that doesn't mean the investment strategy is going to change at all. It just simply means we need to go back and say, look, this is what's happened. We're still going to, like with the market correction, like if they came out and it looks as though from this morning, there's been 2 or 3, and it's still early days yet, clinical trials both here in Australia and also over in France, that a anti-malarial drug, antiviral drug, chloroquine, has actually cleaned up coronavirus within 6 days and may well be used as a preventative measure. The good thing about that is they're obviously going through a lot more clinical trials. The FDA, our TGA will go through the same thing here in Australia, but it's a ready available drug. Now, if that actually came out and said, okay, well, within a month, this is fine, people can take this, everything's okay, then you can expect the market to bounce back. So if that's the case, then obviously we've gone below our asset allocations for equities, but we're now back right in the ballpark there. Now, you should also review your strategy at least annually and document that you have undertaken this review and any decisions arising from the review. For example, you could do this part of the annual meeting minutes. You should then provide these minutes or other evidence of review to the auditor. Now, I want to come on and show you later how to do this very easily. In fact, I'm going to cover every point in here very easily to show you what's involved. So let's have a look at what my auditor's role is in the strategy. And again, this is being directed to the trustee, not the individual. When conducting the annual audit of your fund, your auditor will check whether your fund has met the investment strategy requirements under super laws for the relevant financial year, which at the moment they've looked at 2019, but we are in the 2020 year. This means they're going to check your SMSF had an investment strategy in place for the relevant financial year and consider the factors outlined above. So it's a really good question that you were saying, Cherie, in terms of I've got 0, 100%, the auditor is now questioning it. What's the process? Secondly, that your fund's investments were in accordance with the investment strategy. Now, if there is an investment strategy and you've made investments inside that investment strategy, that is a defence for the purposes of, of any action for loss or damages for investment strategy. So that's what you need to do. Plus your strategy has been reviewed at some stage. So there's that threefold circumstances. Now, where you don't comply with investment strategy, your auditor may need to notify us by lodging an audit contribution report. So let's go down for this one, just the last couple of minutes. There's a 3-strike rule. If your auditor identifies that you've breached investment strategy requirements, then you should fix the breach. So that's the first strike. The auditor comes back, you've struck out, you must fix it. If your strategy failed to adequately address some of the factors mentioned above, such as inadequate diversification, you can fix this by attaching a signed and dated addendum to the strategy or trustee minute, which addresses it. You should then show this to the auditor prior to the finalisation of the audit. Now, if you fail to invest in accordance with investment strategy, you should revise your strategy, blah, blah, blah. Anyway, now, this is the big one, Cherie. You auditor only need to lodge an ACR notifying us of the breach if it meets the ACR reporting criteria. For most funds, particularly ones that have been around for more than 15 months, the auditor has identified the same breach in a previous income year and has been repeated in the current income year. Or it is a breach from previous income year that remains unrectified at the time of audit. So that's going up to here, where you've been told to fix it up, they haven't fixed it up. Now here's where it comes in. So the auditor lodges an ACR. So I can tell you from what I've been seeing, there's lots of ACRs about to be deluged around this. It's just simply too much risk with the auditors of Cam and Bear, with also Baumgartner's case and 55.3. Now, this is a good one. If your auditor is required to lodge an ACR and the breach has not been rectified, which is essentially what's the case, we will ask you to rectify the breach. So again, the 3-strike rule. First one, the auditor says this is not investment strategy, goes back to the trustee and says you must rectify this strategy. The trustee sends it in and says again to the auditor, well, we don't know what we're doing or we haven't rectified it. At that point in time, the auditor is going to issue an ACR, 2 strikes. Then you're going to have the happy knock on the door from the Commissioner of Taxation, who's going to say, we want you to rectify that breach. So at one point in time, it doesn't matter what happens, is the client's going to have to rectify the breach. Otherwise, there's going to be a penalty of $4,200 for each individual trustee. And I worked out that I think I'll just get my little calculator out because let's face it, with all these handouts because of the coronavirus, that essentially, if I just get my little calculator out and I'll put in here, because these are individual trustees, so that there's probably going to be at least 600,000. In fact, there'll be more than that, 600,000 funds. So there's going to be about 1 million potentially fines on offer times 4,200. There you go. That's $4,200 million or $4.2 billion. Now, if they could get that off SMSF by way of penalties, that would certainly sort out a lot of these budgetary issues. But anyway, what I'll do is I'll hand over to Warren and also Stuart. I mentioned I came across Stuart from years ago when I was at law school. He was definitely a very big reprobate in those days. Essentially what Stuart did led me on to Warren and having a look at these amazing solar plants they're building very close to corporates, very close to businesses, which I certainly think are the way of the future. But anyway, I'll hand it over to these guys. I'll stop sharing my screen and then I'll come back a little bit later on and give you solution after solution and a few strategies for the current point in time.
Hi there, thanks Grant, and welcome to everybody in this day and age of social distancing, and wish everyone is good and
of course with the 1.5 metres between us at the moment.
Exactly, and great introduction to you, reprobate Stuart. Yeah, Grant set out there that we set out to design the Australian solar product as specifically for the SMSF audience. It's really been set up as sort of 3 parts income, 1 part equity. And why have we targeted solar? Partly it's the low risk on the operations side. It's the fact that solar is so predictable. Mathematically, you know how much sun is going to be in a particular place you locate a solar farm. And if you contract the revenue, you're close to the load so that you don't have the risk of any type of a loss of that revenue, then you've built a very, very predictable and very, very low risk asset class, which is why this asset class appeals so much to the institutional investor. So by way of background, that is very much my background. I came to this having developed many funds for lots of institutional clients in the renewable energy, and in fact right across the thermal generation business as well. And in discussing this with Stuart and with Grant, we really felt that this was an asset class that really suited the SMSF audience. There's a slide pack. I'm not sure if it's in front of the audience here at the moment, but we'll make it available anyway if it's not. But essentially, we just talk about the background of renewables, the fact that it is such significant growth in the Australian market and the global market. The predominant reason for that now is that this solar and wind are by far the cheapest entry point into the generation market. As we know, electricity is an essential service, probably even more pertinent at this point in time as the government insists on industry that will have to continue no matter what, and essential services and power are part of that. We concentrated on small assets deliberately because the larger ones have more risk in terms of counterparty risk, are harder to contract on when you've got a bigger scale. So we're really targeting small assets with all of the revenue contracted, or as much as is possible. The first of our projects is in Robinvale, Victoria. We have an option to purchase a 9 megawatt solar farm. The solar farm is actually well underway. You'll see some video of time-lapse cameras and the like of that asset. It's due to actually start operating in about 3 to 4 weeks, and the revenue is wholly contracted to a retailer for 7 years with a 3-year option to extend. Second one of our assets is in Byford in West Australia, a little bit different in the sense that it's on the outskirts of Perth, and so Normally, we wouldn't want to own the land. We would just lease the land. But in Byford's case, we would look to own the land because the underlying land has significant appreciable value, because Byford is a fast-growing suburb in Perth. All of the offtake, or we believe all of the offtake, will be contracted to Wesfarmers. In fact, they reiterated their full support for the project last night. Credit capacity revenue is another feature of the West Australian market that's not evident on the East Coast. Basically, all generators, whether they be gas, coal or solar, receive income for essentially being available at peak times. And we qualify for that, which would be a lifetime revenue stream from what is effectively a government-assisted program. The other feature of Byford is it will be the first large-scale battery into the West Australian market. You've probably all heard of Elon Musk and the Tesla battery that was put in for the summer last year. Big success. It was somewhat subsidised. We have no subsidies whatsoever, and I think that's really a feature of that capacity credit market that I just mentioned, effectively an insurance process for capacity. And the last of our projects that we're talking about at the moment is in Griffith in New South Wales, around about 30 to 40 megawatts, still final decision to be made on that size in the near future. Contract has been selected, preliminary work is underway, and we expect that asset to be finished by the fourth calendar quarter of the year, about October, November. In terms of our future plans, we may IPO in the future if that's deemed the most sensible thing to do. Just don't know in this day and age of where we are, but let's just assume that we all get back to normality. We're looking at some expansions of the solar farms that we are looking at, particularly Robinvale. We can add batteries into that asset when the East Coast market is receptive to that. At the moment, our view is that batteries economically are still not quite there for these projects on the East Coast. They certainly are on the West Coast, and in Byford it really works well. So not quite there yet, I don't think, but will be in the next 3 to 5 years. We're also looking at diversity, so we're looking at assets in Queensland, and we also have the opportunity of a small solar farm in West Australia. So we would expect, if all things go well, that we could list in a couple of years. That certainly presents some upside on our equity offering. Next slide we talk about is just how we contract the revenue on these projects, and we give the example of the Wesfarmers power purchase agreement. Essentially, we contract all of the electricity and any associated green rights, particularly the Commonwealth Government Renewable Energy Certificate Scheme. And it's all contracted to Clean Heat, which is a subsidiary of Wesfarmers Chemicals, Energy and Fertilisers Group, which by itself is a multi-billion-dollar business. As probably mentioned earlier, term of that contract is 10 years with ability to extend. And I'll pass on to looking at what the offer is itself. As I said earlier, it's both an equity and, if you like, a debt offering. Those instruments have been carefully designed around giving a certain income stream by way of redeemable preference shares, which are offering a 7% per annum coupon. A coupon would be paid quarterly, and then an equity offering, which we anticipate would return around about a 10% internal rate of return. And then I think we should just finish up, Stuart, by just discussing the key dates on the offering and the process if anyone's interested in investing.
Yeah, I think there's another quick point too, and that's when we started thinking about how we're going to structure this offer, and that was just over 12 months ago now. It struck us that infrastructure, safe infrastructure investors were not really the the domain of SMSFs and retail investors. So we thought there was a great opportunity to do something, and with Grant's help, we were able to structure, as Warren said, a dual offering, which facilitates the growth of capital for people in the accumulation stage of their superannuation fund, and on the other side of the coin, allows people a very reliable income stream if they're either in their retirement years or approaching their retirement years. Now, I would, if you're interested in having a chat with us further, please get in contact with us. Our details will be made available there on the slide pack. You can call either Warren or myself personally. Our numbers are there, and our email address is through an info line through the manager. You can download the prospectus and the application forms from our website. Our website's a bit of a mouthful, but it's austsolarinvestments.com.au. And lastly, just because of the uncertainty and the difficult climate we're in now, we've extended our offer by around about a week. It now closes on the 20th of April. We lodged a supplementary prospectus earlier this week just to extend it out, to give people the opportunity to maybe, and hopefully at that time, get a little bit more comfortable with what was happening in the world, and maybe give them a little bit of time to make a decision to invest. So anyway, I think that's all we want to say. So thank you for the opportunity of allowing us to speak to you. And,
yeah, I've got can you hear me, guys?
Yeah.
So do you just want to cover the, I'm not sure if you did or not, you know me, I'm a bit like you, Stuart, probably had too many red wines and things just a bit like a sieve these days. So obviously, do you want to talk about the management? Is that this isn't a traditional funds management. It's actually been structured as a company. First off, look at that. Secondly, talk a bit about the manager, SMSF Funds Management. And then thirdly, just talk about the management fee. So people can understand that when you are getting the electricity contracts, either through Clean Heat, all the corporates that are coming to you, that effectively it's not coming to you guys, it's actually going to all the shareholders. So you're securing this lifeline for them.
Yeah, that's right. So we set out to offer a product that, as Grant alludes to, is a little different than the norm. There are no performance fees here. We'll invest alongside the investors. There'll be a relatively low management fee of 1%. And the whole structure around this was designed around providing as much certainty as we could, based on all the lessons that we have learned during our lifetime of these kind of assets. The manager is made up of an experienced group of people who have done many electricity developments, as well as and had a lot to do with funds management and corporate activities. And Stuart's a good example of that, with a long history in corporate Australia. We are very focused on giving as much certainty as we can, as much certainty as possible on the revenue side. So, as Grant said, it's structured as a company. The investments will be in subsidiaries, and when we talk about corporates that might contract with a retailer, for instance, for the output of, let's say, for instance, Robinvale, then if that credit is better than what the retailer is in the first place, there's no reason why that corporate doesn't become the counterparty, and therefore a better credit is made. We will actively manage these assets for that effect. It's in our interest, in your interest, and so we think that is a very fair structure. And as more than fair, it's about making sure that income is protected at all times. So as much as we can, anyway. So that's really the approach we've taken, is very much designed around the SMSF industry and people's interests in terms of what we think based on, you know, healthy amount of advice from Grant is what we require.
It's actually, sorry, go on.
Sorry, Grant, I was just going to say, one of the, when you start looking at how to structure these things, you do a lot of reading, and 12 months ago, reading a lot of prospectuses and offer documents for other infrastructure style funds and property funds, you literally get lost in trying to understand the fee structure. So we tried to make something that's very simple, very digestible, and something that completely aligns our interests with the interests of retail investors, not the interests of large institutions. And that's really been highlighted by the fact that we're only taking a 1% management fee. And if all investors win, then we come out happily at the end of the day with everybody else.
It's quite interesting, just a bit of a somber story here, that last week when we were in Melbourne, it only just got, can you believe it, it was only not that long ago, and everything we saw that, you know, things were just happening, and how things can fall off the perch in such a short period of time. One of the guys there that we were dealing with had quite a bit of a stake with some other investors in a company that actually is Tasmania.com, and they've done very well going out and obviously, you know, pitching Tasmania everywhere, and obviously, you know, promoting all the products for a fee, much the same. And I had a chat with the guy last night, and he was absolutely distraught because effectively the whole thing is blown up. I mean, they can keep it going for a while, but with Tasmania now out of the picture, in fact, not only is it not getting any tourism, won't even let tourists come in. So it's like it is a true island of itself. It's virtually seceded from Australia. And that's quite interesting, that security issue is pretty important. And I think it's, you know, I'll probably just raise a question there with you, Warren, that that security issue probably has really been highlighted in the last couple of weeks for everyone, is that, you know, you can't rely on stuff necessarily coming from overseas, but also these large power plants, whether they're solar or coal, if they're just too far away and something happens to them from a security point of view, you're pretty well stuffed. And I think it's quite interesting going back now where we look at it, that the BIFA that's coming up is actually being sold to Wesfarmers, which is probably out of any retailer is having its busiest time ever. So sort of it's using this sort of platform in order to secure its electricity by itself rather than relying on the grid. Would that be correct?
Yes, it's certainly looking to secure. It's certainly looking to secure certainty over its energy risk management via the BIFA project. I mean, technically, you can't tag the electron, so you can't say that the energy goes to Wesfarmers, but certainly from a contractual and a financial sense, you can, and that's exactly why they've done it. I don't think I've ever met an organisation with as much risk management processes to go through as Wesfarmers, and it's times like these that you actually appreciate why they do them. So yeah, it's an asset we're very proud of, and we expect that it is the model that we want to see happen throughout a growing portfolio. And yes, you're quite right about investments of all sorts of different times that look quite secure, and later, you know, in the last few weeks that don't look so secure now. I think we're probably all got them in our portfolios, to be honest. But you know, that is fundamentally why we like the sector. It's an essential service. We can contract it for good parties. We have the assets themselves. The redeemable preference shares are really secured by those assets, which in turn we've secured by revenue contracts. So you know, it rides through these situations really well.
So at the end of the day, they're pretty damn boring, but they're not unicorns, but they work.
Yeah, no, we're not going to suddenly be listing on NASDAQ and making $5 billion. it is fairly boring. It's what it's set out to be. It's a consistent, reliable asset that the sun shines. We all know it's going to shine. It's one thing we've got knowing about the future in Australia, and we can predict how much energy is going to be produced, and therefore we can predict how much revenue we're going to earn.
One thing, because you've been around for a long time, and you know you've had like 20 or 30 years with Babcock and Brown, and obviously your skill is with energy assets, and you know you put away what $3 or $4 billion of coal, wind, and all that, and having a look at the market at the moment, just from a general perspective, because you keep your eye and ears to the ground, and you can see. So what do you see coming over the next couple of months, 2 or 3 months? What do you think the coronavirus is doing?
I think the honest answer, Grant, is none of us really know. But my suspicion at the moment is that with people working from home, we're going to see a different shape to the energy consumption. I think we're going to see more peaks in the afternoon and evening because there's so many more people at home already. I think there's less flat load. By that I mean the industrials that work through the night and right through the day. We just don't know how many of those are going to be able to continue on. But I suspect they will. And I think what we'll see is just a more residential load than we typically see, and therefore you'll see a little bit more higher prices in the afternoon in the energy market.
Thanks for that, Warren and Stuart. And what I'll do is let you go, and then we'll get back to the exciting stuff of investment strategies. Not as good as yours, but anyway, everything gets exciting from here. So I'll get Chris just to mute the guys, and thank you very much for your brilliant efforts.
Thanks for the opportunity.
Thanks. Okay, guys, let's get on with it. We've had a look at the Commissioner's guideline, which is pretty important, and I've got a few questions from you, so please feel free to pepper me with a lot of questions as we go through. I'll just bounce out of this presentation and get back to mine. I just want to cover a couple of issues on the final one that I've got. If I just go down here, we've done the Commissioner guidelines. These are some of the ones that I just want to look at before I go and have a look at a solution. So, as I said before, we're right in the smack of the 2020 income year, and we should have had a plan in place for 2020. From that perspective is what do we do about 2019? I want to take you through exactly how we cover that. What are auditors going to do? I know there's a few auditors on this webinar now, and I think it's a great opportunity to get and have a look at. But as I said, I spoke to 300 the other day. I think it's going to take a little bit of a shakeout this year when someone drops like a nuclear bomb on it. But look, expect it to come out a lot further. How do we cover members, the super benefits and insurances? What happens if we are essentially all in cash and want to stay in cash, or all in property, or all in equity? So I want to cover that. This is an interesting one, and essentially you may or may not be aware of it, but under SIS regulation 13.14, you can't charge an asset, and that means buy a mortgage or give any charge. But there are some exceptions for derivatives, and a limited recourse borrowing arrangement fits squarely within that scope. Wherever you give a charge over an asset, it's deemed to be a derivative, which means that you need to have a derivatives risk statement. And that's not only now, that really goes back to 2007. So I want to cover that. A related party we won't do a lot. Cryptocurrency, just be extremely careful. We've had quite a few questions through how to cover cryptocurrency, which I want to have a look at and how that's done. But more importantly, just be aware that after the investment strategy, a couple of things that are on the Commissioner's hit list, so to speak, are cryptocurrencies. So be very careful with that one. The second one is 2-member superannuation funds. Now that he's got big data, he can find out how many funds you're in. so that if you've got if you're in 2 superannuation funds, expect to get a letter from the Commissioner asking you why you're in those both of those funds. Thirdly is also if the fund doesn't have a bank account, expect to get a letter from the Commissioner. So now the Commissioner is getting a lot, and I just saw that they've even updated their compliance again for the income tax return, and they're getting digging deeper and deeper as we go to find out a lot more information from us. So let's just jump out of here, and what I want to do is just take you to a couple of things. One that I would suggest that you may want to do. So this is the Lightyear Docs site. I'll just take you to the home button. I'll come and cover those questions a little bit later on. Now, you can see up here on the left, up on the right, sorry, I've got the support centre. Now, if you just go into Lightyear Docs, for example, if I log out here, you can see here, I've only got home and product categories. What you can do though is log in, and if you haven't looked over the site, book a demo with me. You spend good 30, 40 minutes with me and we'll go through a whole lot of strategies and pepper me with ideas. So please feel free to book in. But if you want to log in or register, what will happen is once you do that, effectively you can see the support centre starts to pop up there. And once the support centre pops up, what I would do is direct you to that support centre. It looks as though the internet's like, poor old NBN's not handling it well with so many people sitting at home these days. The support centre is part of our site. It's a separate part that's only opened up once you guys effectively registered. And there's no cost of registration. It just simply makes sure that we can get your details so you can get access to the support centre. A couple of things here. You're going to find there that there's a whole lot of videos that are available. So every session I do actually goes up here, and I've done 3 this week. The one I did yesterday was on enduring powers of attorney and wills. We've got a great product there for that. The other one I did on March the 18th, 7 legal strategies to access your super. If you didn't get access to that, absolutely, that's a crucial one, because effectively for a lot of your clients, they can start to access their superannuation right now. In fact, one of the strategies I had a look at, the government announced and started to promote it the other day. If you go through to the end, you'll see I've got a petition there potentially that if things get really bad, we should be looking at accessing no more than 10% of our super this year on a once-off basis. But quite apart from that, have a look at that. But if I go back here, and you'll see here on the strategy info and advice toolkits, there's a really good letter here. So you can see here the asset protector. I'm coming out and doing a session with Tim Munro on that next Thursday. The wills and EPOA, have a look at really that. But again, I'll put that up on the system very shortly. But this SMSF investment strategy upgrade letter. So you can simply go that. Look, it doesn't matter whether you use our system or not, but once you see the system, look, you're going to be blown away. But you can download that document. And then when you download the document, and I want to go through the process here because this is the way we work at Lightyear Docs, and particularly to get, as you can see, there's a deed of rectification, so sorry about that one. But what we do is just to show you how it works in terms of providing legal advice. So this is a sample investment strategy and indemnity letter. So again, I'll just apologise, I've got a bit of, here we go. So everything's very, very slow. I blow it up, but there we go. Let me just see if I can get it onto one page there. Just a little bit further. Sometimes my stuff goes a bit wonky. So this is just go and have a look at all this. This talks about where you fit in, so on and so forth. With the investment strategy, we've got here urgent, the Commission Taxation Blitz on super fund investment strategies. Now, as I said, you can back off if you're an administrator or accountant, and you can basically wash your hands and say, look to the client, you have to do investment strategy. The issue about that is the client's going to have to do one, but you know they're going to hit 3 strikes because they're going to give it up to the auditor, and the auditors, there is no way in the world you should be doing an investment strategy for your client. You're there to review the investment strategy. Now, if it doesn't meet the criteria, then pass it back. Now, for the accountants out there, then the question that always comes up, but how do I do it? Do I need to be licensed? Now, I'm going to take you through a simple three-step process on what to do. So the first one is we send out this letter. Now the letter basically is addressed to the trustee of the fund. So we're not addressing it directly to the members, it's to the trustee of the fund, because at the end of the day, it's the trustee of the fund that the Commissioner's referring to, and Section 52B2F relates to the trustee of the fund, not the members. Now, the Commissioner of Taxation has recently written to a number of our clients regarding their SMSF investment strategy, which is the case. This action with the Commissioner of Taxation being followed with guidance note to trustees such as yourself. Importantly, notes investment strategy must be in writing, all the stuff that we just had a look at in derivative statement. Importantly, the trustee must have an updated investment strategy that meets the new guidelines for the income years ending 30 June and also 30 June 2020. So what I want to do is build two investment strategies in one. The Commissioner notes that if the auditor qualifies the investment strategy, there is a $4,200 fine. Now you can amend this because again, it's a Word doc. Now to ensure that your fund meets these upgraded and updated guidelines, we suggest a three-step process. Here's the important one. Now, what I need to do is anyway, it doesn't matter, let's just go through the process. Complete the attached data capture showing what asset classes your fund intends to invest in and broadly what percentages to allow for rise and fall in asset prices. For example, this may be 10 to 30% in cash, 60% in equities and managed funds. If you're unsure what to do, please contact us so we can help you prepare the fund's updated investment strategy from scratch. So that's the first one. I'm going to show the data capture in a second. Forward the data capture to us and we'll look at all the circumstances of the fund, members' ages, superannuation benefit stage, plus other investment strategy requirements, and then complete a draft investment strategy for your review. So essentially the client is giving you the data and you are preparing the data. A review of the investment strategy by the trustee of the fund and sign off using the trustee minutes will be attached to the fund's investment strategy. The final investment strategy will be reviewed by the fund's auditors, sign off for compliance purposes. To be transparent, all auditors have been put on notice of the upgraded ATO requirements for SMSF investment strategies. Now, the above will take some time, but we can do two income years in one. If you'd like us to do the investment strategy for you from scratch by interviewing you, the cost is $550. So that's if you're getting them into your office, etc. However, if you complete the data capture, enabling us to correlate this information with fund member details, a lower fee of $350 will be charged. Again, you can just choose whatever you want to do. Now, alternatively, you can produce the fund's investment strategy, having regard to all of the above factors and following a review of the ATO investment strategy requirements as published on the ATO website. Now, this is the important one. In this case, we take no responsibility for advice to the trustee in respect of the fund's investment strategy, thus indemnified from any recourse against any possible penalties or fines of $4,200 per trustee. So I strongly suggest that you want to send that out to your clients now. Now you could do it for those of you who've got MailChimp or you've got, for example, any mail system or Practice Ignition, send that out and then have this data capture. So the data capture actually goes through a lot of the stuff we just covered. It's pretty self-explanatory. Please go and get it. Just register on our site. Please go and have a look at it. And then you go through, see here, domestic cash, benchmark allocation, international, going through each of these ones there. So Graham, I'm going to show you how to look at that. So that's the first step that we want to do, is set out our clients, because you can't have the Commissioner notifying and not going out to the clients, because ultimately if it comes back and the Commissioner starts to audit them, then you're right in the firing line. So what I want to do is just drop up now and we're going to go into the Lightyear Docs site proper, and I'm going to have a look at our home. Now we've got two different sorts of investment strategies. We've got the first one, if I go to investment strategy, and this can be found down in the SMSF, I've got a member-directed investment strategy. So for example, we could have a younger member inside the fund, so a 40-year-old who wants to enter into an LRBA. So you can produce a separate investment strategy there for them. It may have differences for tax purposes. You may not be able to segregate for tax purposes if one of the members has more than $1.6 million in the fund. However, you can segregate for both trustee and also SIS purposes. So there's nothing wrong with separating that. And there's a number of tax reasons for doing so, particularly with LRBAs, because the liability, that's the amount over and above the actual equity the fund holds in an LRBA, is to be split proportionally across all members if you do a fund investment strategy. So what I'm going to do is I'm going to do just a fund investment strategy for all of them, and not a member directed. So I'll go in there. You can see up there I've got the LY strategist. I'm going to put in there grant test. You can see it goes green and bingo bango, and I'm off and running. So I will generate this, and you can see here, sometimes the system doesn't work that well with Google Chrome, so you'd have to use the Microsoft Edge. So have a look through this. Remember I set it up as grant test. So what I'm going to do is I'm going to call it Solar IS. Now, document branding, if you're on our system, you can actually get all your documents white label, and I'll show you what that looks like. So general, what's the fund's name? I'm just going to keep it generic here. So the Smith Family Super Fund. Now that's the easiest one. Now from here on in, everything becomes tailored and also bespoke. So what I want to do is just take you through why we're doing things, and more importantly, why are we doing specific things for that. So what date was the fund established? So let's say the fund was established on the 1st of 03/2011. You might say, well, what's the use of that? You can see that I made a mistake there. I'm going to come back to that. So I just want to put that in your mind. I've actually put in the date of establishment into the investment strategy, and that's important. What is the end date of the current income year? Does anyone want to hazard a guess of that one? Because we're doing it for what date? It's 30 June 2020. Now I'm going to cover that a little bit later on. Now, would you like to have a customized investment objective? Now, generally, I prefer this one, that's basically to meet the members' retirement benefits. But if you want to put your own customized investment objective in there, feel free to do so. And then what would happen there is you can put in your standard, whatever you want to do there. So it's a legal system, so it enables you to put in words and also paragraphs in there to cover specific. So there's the first. We've had one, which is what date the fund established. Now this is the second option. We're going to keep on going through. Has the trustee of the fund received a diversification letter? Now, if you have for your client, you prick yes. You don't go and leave that out. You either go yes or no. Otherwise, it leaves forms unfilled. And if you've received a diversification letter, I'll go no. Actually, no, I'll go yes. We'll go heavily into property. Now, do you want to rectify and ratify an early investment strategy? So if you want to do 2019, then what we do is 30 June 2019. Now, bearing in mind, the guideline the Commissioner gave effectively goes back to 1994, but there's only so many years. You can go back 4 years, essentially, to amend. So we might want to go back a little bit. If we're not comfortable about prior years, let's just go back 06 to 017. Now, I'm going to show you what that means, but what I'm doing is up will pop a separate document in our suite of documents, which is where we're going to strategy automation with Lightyear Docs, and this is the brilliance of the system I'm building, where we can put multiple docs into one. Now, we're going to put the trustees' details in. Obviously, we've got a corporate trustee, and I want to give you a bit of an idea around here. So we'll call it Bridges Smith. What's our ACN? 1, 2, 3, 2, 3, 4, 4, 5. We're going to put our street line address. So 5 Smith Street, Sydney, New South Wales, 2000. Now, how many directors? Now, here's an interesting one. Let's just put down, I want to come back to this. I'm going to put down 2 directors. So I'll put down 2, and I confirm, and that then puts the director's name up. So I've now got John Smith, who's the dad of the fund, and he's going to be signing off. So I click that. And then I've got Matthew Smith, which is his son, who's also a member of the fund. So it's a 3-member fund. We've got Matthew and we've also got John. So make sure you tick the boxes, and I go next. So we've got a meeting. I leave that blank, and I'm going to come back. Why? Because I don't know when that meeting is going to be. Generally, it's going to be at your office. Now, we know the meeting is going to be at 5 Smith Street, unless we put our registered office in there. John is the dad, so he's going to be the chairman. Then I can go through the members. Now, remember, please enter the number of all members that are covered under this investment strategy. How many members of this investment strategy? So this is where we start to put in. So there's 3 members, but there's only 2 directors. So I'll go back. Remember, we did the 2 directors, but there's 3 members. Now, if you maintain reserves, I know some of you do, I'm just going to click this to show you what happens. I'm going to invest in cash. I'll show you what happens a little bit later on for that. But generally, if you don't do reserves, you just click no. We're trying to build everything into one document. So the first member we know is John Smith. I put down his age, he's 61. Does he have a pension? Yes. Does he have an existing insurance policy? No. Does he have an insurance policy for the strategy period? No. And then I simply add another. Now I've got Sally Smith. She's aged 60. She has a pension, no insurance, no insurance. Now, Sally Smith is a member of the fund, but she is not a director of the corporate trustee, which seems to be in breach of Section 17A of the SIS Act. However, Section 17A 3B, and you'll see from the video that I put up today that goes on to the side in relation to EPOAs and also wills, that effectively from that perspective, what we have there is where we have EPOAs and wills, if Sally has given her super EPOA and it needs to be a super EPOA to John, then John acts as a double trustee or a double director on her behalf. Let me go through, and that's not a bad idea because there's a lot of your clients have got elderly mums or dads or whatever who shouldn't really be directors, or there's next generations. So if you've got an EPOA, and you can do one just for super alone on the Lightyear Doc site, then effectively just bow them out, do a 484, get rid of them as a director, and then we're off and running. So I've got Matthew Smith there. He's age 40. Does he have a pension? Nope. Does he have insurance? Yes and yes. Now we go into our cash. Does the fund hold more than 75% of its investment strategy in cash? If it does, then we need to click yes, because I will pop a separate paragraph which looks at diversification as per the Commissioner's ruling. Here I don't, but I'm going to be investing 90% in property. So what I'm going to do is go between, for cash, 10 to 30%. So that gives me a bit of coverage in case I make contributions during the year. And remember, there's going to be rent coming in, there's going to be contributions, so I might build up my cash pile there. So remember, the Commissioner says you want a bit of flexibility. International cash, well, I've considered it. Do I want to go in international cash? Zero. So that's where that is covered, Graham. Fixed interest? Nope. International fixed interest? Nope. Equities? Well, I might want to diversify. Do I hold more than 75%? No. But I might want to diversify. So I might go 5 to 15 during the year. So I want to get a bit of a breathing space from, some contributions, etc. It might be a good time of the market. Does the fund invest more than 75%? Yes. So I'm going to invest in domestic property. I'm going to go from 60 to 95%. Now, I then can choose, I could go residential and commercial, which pops up different benchmark allocations. So I'm now starting to do this. But what I'm going to do with the residential, I'm going to go 60 to 95%. So you can see my top range, 95 for property, the 15 there takes me 110, and then potentially 30 there. So I'm up by 140%. It doesn't matter. So I can mix it around. It's always going to be 100% because you can't invest more than 100%, but my allocations will take me over. So I'm going to go to alternatives. So this includes hedge funds, private equity, art and antiques, futures, derivatives, credit, etc. I'm going to go 0 there. But I am going to have an LRBA over that property, the residential property. So I'm going to click yes, because I need to have a derivative statement. Now my borrowing, the LVR across the whole of the fund, not only just that asset. So I'm going to go 30 to 50. So it's pretty conservative. Remember, we've got some cash and equities potentially in there as well. So again, I want to have a bit of a benchmark. Now, another asset, do I want to create a custom asset? So for example, if I go there, I can create as many custom assets as I want. So for example, I could put in there Australian $1. Oops, sorry, can't even spell Australia. Come on, Grant. Be patriotic. Australian dollar redeemable preference shares. What are the key characteristics? Then effectively, they are to provide an income stream for pension members, and the 7% income flow is greater than the 4% minimum pension. So pension factors. In fact, I've just got my PDF open at the moment, and 7% applies for people 80 to 84. Now, if you had a look for these guys anyway, they're going to be miles off. So they're going to be like 15 or 20 years before they have a problem. Remember the redeemable prefs, they keep on going with it for a minimum of 10 years. What's the trustee time frame? 10 years. What is the asset benchmark allocation? We might go 10 to 30. If I wanted to add another, if I wanted to put gold in there, if I wanted to put cryptocurrency, that would be there. So you can customize any field. While you're there, if you've got any questions, you can always just press support and ask us questions along the way, particularly technical questions. So I'll now finish that. And so what it's doing is it's going into our system and starting to pull out of all those billion options, we're now starting to tailor quite a specific document for these particular clients. So again, it's just taking a little while. I should have done it on my phone, but anyway, it pops up pretty quickly. So it'll either come up with your logo, but because we chose Abbott-Family, it comes up with their logo, and all their documents are signed off by Abbott-Family. So I'll just go through quickly in the last 5 minutes so you understand. Oops. So this is just a bit of a blurb up front for the client about what an investment strategy is, what's required, so on and so forth. What I probably am going to do actually very shortly, I might get rid of this and I'll put in the Commissioner's guidelines around investment strategy and put that in there. Again, it's not a bad idea to use the Commissioner's own words for our clients' purposes, and particularly for the auditor. So the first thing is we've got the trustee acceptance of the fund's investment strategy. You can see there all the directors we put in. Now, Sally's not in there. So we go through the trustee resolving investment strategy, and then you can see that's John and Matthew, but not Sally. Now we get to the deed of rectification, ratification investment strategy. So this is a separate document, just to give you an idea. When I do deeds of rectification, ratification, the charge can be up to like $1,000 per rectification, depending on how hardcore it is or what you're doing, particularly if it goes back, for example, way back to 1970, as I did this morning. But here what we're doing is we've got the trustee. The Smith Family Super Fund was established by deed dating 1st of March 2011. John Smith is and Matthew is the current directors and members of the fund. The trustee of the fund has previously created an investment strategy pursuant to regulation for the following income years. An updated and rectified investment strategy as prepared by the trustees attached to this deed as the funds formally hereby rectified. So what you're doing is you're throwing it out by rectifying it, and then you're ratifying it. So the trustee is now saying, this is our investment strategy for the prior income years, which is traditionally what we do for LRBAs and fixes like that. Now, this is the investment strategy per se. What we've got there is, look, if you don't want all of these documents here, the best thing to do is just get a good PDF like Adobe or Nitro, and you can pull this data out, extract that page. An investment objective, see that I've got that there? That's the one that was in our system. Now, if you had a customized investment objective, it would pop up exactly word for word there. The members' names, remember that? The pensions, yes, and insurance policies. Now, we've got a bit of a blurb here, really just from what the Commissioner's saying and by way of a background. Asset allocation. So the trustees ensure the fund's portfolio, blah, 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 anyway. The issue of risk. So we cover a whole lot of that. Now, the trustee of the fund holds more than 75% of its portfolio in property, as considered as aware of the risks involved in holding a significant proportion of its portfolio in one asset class. At this time, the trustee accepts the risk of poor returns and depletion of capital, but will monitor its position regularly if need be, diversify to other asset classes. So again, that's covering that issue that the Commissioner went in there. Borrowing, So we've got 30 to 40, 50% in there. Diversification, a bit of a gate risk. So we cover about single properties, being highly diversified. We've got here, the trustee fund holds more than 75%. They're looking at that. The trustee fund has decided to invest in residential as a long-term hold, 10 years. And although the asset allocation is significant, the contribution members are ready to ensure the fund is cash flow positive with cash reserves to be diversified in the future. Again, so by ticking that box in these different, so this is the box where you go more than 75%. This is where you tick the box that you're in property and it's greater than 90%. Cash requirements, this one, the trustee fund is liable for the payment of pensions as requested by pension members of the fund. The investments held by the trustee for the pension members have been specifically required to maintain to meet the cash needs of the member. That's why that SOLA works really well. Balancing risk and returns, we've got that there. Now we go into our asset allocations. Domestic cash, remember I put that in there. I like this one because what it's doing is saying, look, we've thought about international cash, but we're zero. Domestic fixed interest, international fixed interest, domestic equities, zero. Can you believe 24% of Australia's 2.2 trillion in residential, retail and industry funds is invested in international equities. Can you imagine what's happened to them in the last 2 or 3 weeks? International property, not interested. Domestic property, yes, and residential is 60 to 95%. Alternatives, zero. We've got the borrowing in there, 30 to 50%. And here's your Australian solar RPS. So see how I did all those words? And that now is super tailored because I'm actually putting specifics. As I said, you could put cryptocurrency. If you haven't got cryptocurrency in there and you get audited by the commissioner, you're in big strife. Here's our investment strategy and insurances. The fund has considered the requirements of its members in terms of insurances, noted the adequate life and TB put in place for the following members of the fund, Matthew Smith. Now, obviously, you don't need to look at insurances, so this is a negative. The super fund reserves strategy, if you've got one, you can see that you've got cash as the fund's investment strategy. We're having regular reviews, and then we've got options or derivatives. So again, this is the relevant element, the derivatives risk statement. And because I've gone for residential, and I will be building this out, because it's residential, we've also got a research paper on residential property in Australia over the last 30 years. So it's a really good, strong positioning on where the housing market has been and where it's going to. Now, as you can see, this is a pretty heavy investment strategy. Now, I might go in and might say, oh gosh, I didn't do that right. So you can always go back in, go into your vault, because everything now sits in a vault. Remember I did grant test. So I just need to go down here, grant test, and you'll see down below, these are all the documents I've done, wills, investment strategies, and you can see here, remember that's why you nominate what the name is so you can find it easily. And then I just go in and I rocket ship, relaunch it. And then I can go back and say, okay, well, the market has corrected. I'm now going to get out of equities altogether. I can go in there and I can go zero. And then if I produce that, I'll just go to the document. I can go to a document preview at any point in time anyway. So that document preview will now have a look. It's not as beautiful as seeing the system itself. But if I go down there, I'll just take you right down to the bottom. You'll see there's no domestic equities. Remember we had that before? So I've tailored it now. I'm right in the middle and then I'm off and running. Now, I've got a couple of questions before we leave. So from Cherie, always asking some really good questions. If we accept the COVID-19 impact on the share market in particular equals a market correction, which it would be, and therefore trustees who invest in the share market should be reviewing their strategies in light of this event per the ATO guidelines. This is something we need to check as part of any 2019 audits we're yet to sign off on. So it's not going to impact your 19 because 19 is dead and buried. So you'd have to do your deed rectification. For the 2020 audits, remember we said that we don't know whether those equities are going to bounce back. If a client has gone all to cash, then you would do just what I've just done then. I would do a separate investment strategy. So if I go in and have a look here, I've actually got 2 investment strategies for Grant's test. I would have here down for the solar one, Oops, sorry, I didn't finish it. Let me go back. I think. Oh no, I didn't save it. I don't think. No, I didn't save it. Sorry about that. Yeah, if I'd saved it, it would have come up that I've got this one, which has got the equities, and then if I've changed it, I've then got another one. So this is another thing. You can actually go through this system each and every year. It talks about doing a minute, but really, at the end of the day, why go ahead and do a minute when we can quite easily go back into the system? And remember, we're doing investment strategies for 2. This year, nothing's going to change, so it's still going to be the same name. General's the same, but what I'm going to do here is the year would be for next year, 2020. Do I need to do a deed of rectification? No, because I've already covered up everything else. Now, I might need to go and change my strategies. I might have gone back into the market. I might drop my allocation from 40 to 60. I've paid off all my borrowing, so that goes 0. And then I'll go through and then I'll effectively change that investment strategy. And then that will now pop up as my new investment strategy. So with this system, it's best to keep everything in one line, because that's taken me 2 or 3 minutes. Well, not even that, what was it, 20 seconds. By the time I've done that and sent a minute out to the client, it's a lot easier to do this. And then that can be part of your process and also your system. Can you imagine that guy's actually got 10 templates over 500 funds, when really you could actually do all of this? And for the accountants out there, you're simply utilising the system in order to do a data capture for the client. Anyway, look, I've got a 2-day, just a couple of things coming up. I won't bore you too much, but if you have a look at I Love SMSF, oops. I've got there we go, home. On Monday and Tuesday next week, I have a 2-day intensive conference. Because of COVID-19, a lot of it's actually going to be by way of virtual conference. So that's going through asset protection, EPOAs, it's going to go through SMSF strategy, succession, and we're going to go through a whole lot. So it's only about 15 to 20% dealing with SMSFs and a lot about of asset protection. So if you want to go to that, you can go. Unfortunately, you don't want to go face to face. We've got about 10 people, but if you want, you can get the event recording, or you can get the event recording with CPD hours, or streaming and the event recording. So you can still get that if you want to go ahead and do that one. Anyway, that's enough from me. Thanks a lot for your time, and I'll be doing this video up for you. So I've got Brenton Burke. Hi, Grant. Can the investment strategies be amended via likely docs at any point in time? It's a 30-day time period. Brenton, we used to have a 30-day time period, but given the fact that we've got this ongoing element, we can now, under likely docs, it's an unlimited editing for you. But bearing in mind, Brenton, when you edit, you've still got the original one there. So previously we didn't have the original one there, but now you've got a chain of investment strategies. So each year you can come in and build a new one, or you can simply go back if you've got, for example, something that you did 6 months ago, a SMSF deed, and there was a couple of details wrong, then simply go in and fix it. But a really good question. Anyway, that's enough for me. It's Grant Abbott signing off. Enjoy, and let's keep our fingers crossed that they have found a cure, or at least something to prevent COVID-19 and get everything else back to normal.